Hi, this is Tax CPA Jim Trippon with TaxCPAHouston.com. Today we're going to be discussing, should you really care about what the financial markets do every day? You know, it's a good question because investors are people, and people are often impatient. No one likes to wait in line or wait longer than they have to for something, especially today, when so much is available just with a click of a mouse. So this impatience also manifests itself in the financial markets. When stocks slip, for example, some investors grow uneasy, and their impulse is just to sell, get out, maybe get it back in later. But if they give in to that impulse, they may be effectively paying a high price. Across the 30 years ended December 31st, 2018, the S&P 500 posted an average return of 10%. But during the same period of time, the average mutual fund investor only received 4%. Now, that's a big difference. Why would they receive 60% less than the stock market did? Well, part of it's because of impatience. And it's important to remember that past performance doesn't guarantee future results, and the return of principal and value of stock prices will fluctuate as market conditions change. But the thing is that most investors just worry too much. And in the long run, an investor who glances at their portfolio once a quarter may end up making more progress towards their goal than someone that just anxiously pores over the financial websites each and every day. Too many investors make quick emotional moves when the market dips. And logic may go out the window when this happens in order to damage your portfolio. So it helps to have some perspective. Long-term investors often keep focus. Warren Buffett does, and he famously has said to buy in a company because you want to own it, not because the stock will go up or down in the next month or two. Warren Buffett often tries to invest in companies whose shares may perform well in both an up and down markets, but he's also famously stated if you're not willing to own a stock for 10 years, don't even think about owning it for 10 minutes. Now, in contrast to Buffett's patient long-term approach, many investors who care too much about day-to-day market behavior may try and practice market timing, which is as much hope as it is a strategy. To make market timing work, an investor has to be right twice. If his goal is to sell high, take profits, and then buy back in when the market sells off, he may not know when the high really is or when the markets are going to sell off. Even Wall Street professionals have a tough time predicting market tops and bottoms. Retail investors are notorious for buying at the high, selling at the low. Investors who alter their strategies in response to headlines may end up changing it again further. Now, while we expect to be on top of things while doing this, the returns often suffer, and that's what we see. Nobel Prize winning economist Gene Fama once said, "Your money is like soap. The more you handle it, the less of it you have." So be patient. For more information on this or other topics, visit us at TaxCPAHouston.com.